$47 billion. That was the value Wall Street assigned to a company that owned no buildings, employed no engineers, and had never turned a profit. $47 billion. For a company whose entire business model was to rent a floor from a landlord for 20 years, paint it, put in some beer taps, and sublet it back out, desk by desk. That number was not an accident. It was a decision made by specific people in specific rooms for specific reasons that had almost nothing to do with the business underneath it. Adam Neumann. In January 2019, he was worth more on paper than the gross domestic product of 100 countries. 11 months later, he was fired. In April 2018, WeWork's finance team introduced a new figure to Wall Street, community-adjusted EBITDA. It appeared for the first time in the prospectus for a $702 million bond sale. The metrics formula was simple. Start with ordinary EBITDA, then strip out the core costs of running the business, marketing, general and administrative expenses, even the costs of designing and building out new spaces. These were not one-time charges. They were the daily price of keeping the lights on. By removing them, WeWork could present an adjusted profit number that looked positive, even as the company lost hundreds of millions of dollars a year. The prospectus did not hide what was being subtracted. It listed community-related costs as expenses that supposedly did not reflect the underlying business. The result was a headline number that suggested WeWork was profitable, while the actual GAAP figures showed a loss of $1.9 billion on $1.8 billion in revenue for 2018. Analysts and credit agencies saw through it immediately. Moody's flagged the metric as opaque and misleading. S&P Global called it a rebranding of basic operating costs. Business Insider labeled the move a controversial accounting method that reminds experts of the tech bubble shenanigans of the late 1990s. Inside the company, CFO Artie Minson would later admit that community-adjusted EBITDA does not reflect the full cost of operating a community-centric business. But by then, the number had already done its work. It allowed WeWork to raise hundreds of millions in debt and justified a valuation narrative that ignored the company's real cash burn. The gap between story and substance widened, and the market for a time played along. WeWork's business model locked the company into a structural cash flow trap. The core mechanism was simple. Sign long-term leases up to 15 years with annual rent escalators of 2 to 3%. By 2019, WeWork had committed to pay $15 billion in undiscounted rent over the next decade. The average lease spanned more than a decade, with renewal options that could stretch terms to 20 years. These were fixed, non-negotiable obligations to landlords in New York, London, Tokyo, and dozens of other cities. Revenue, on the other hand, was built on short-term, month-to-month memberships. Members could cancel with 30 days' notice. At any moment, a quarter of the space sat empty. The company's own S1 filing revealed an average occupancy rate of just 75%. This meant 25% of leased space generated zero revenue while rent payments continued to compound. The numbers were unforgiving. In 2019, WeWork's annual rent expense stood at $2.5 billion, while future lease obligations towered over current income. A simple sensitivity analysis showed that a 5 percentage point drop in occupancy could push annual cash losses past $500 million. Even at stable occupancy, the cash outflow from leases outpaced revenue by hundreds of millions each year. The lease-to-revenue gap, 30 to 40% over a 5-year horizon, was not an accounting quirk. It was a hard limit on the business's ability to ever break even. This mismatch was not hidden in footnotes. It was spelled out in the prospectus, visible to every investor and analyst who cared to read. Yet the company kept signing new leases, expanding its obligations faster than its revenue base could possibly support. The only way to defend the $47 billion valuation was to ignore the underlying economics and double down on the growth narrative. The lease trap made that narrative indispensable, and any break in occupancy or member demand threatened to unravel the entire structure. Adam Neumann began extracting personal wealth from WeWork long before the company ever turned a profit. Between 2017 and 2019, SEC Form 4 filings show Neumann sold approximately $700 million of his own shares. An extraordinary sum for a founder still running a private company. These secondary sales were presented to the board as routine liquidity, but the reality was clear. Neumann insulated himself from the company's future risk while still controlling its direction and narrative. In October 2018, the board convened to formalize a new governance structure. The centerpiece was a super voting share arrangement that handed Neumann nearly 80% of voting power, despite holding less than 10% of the company's equity. This was not a symbolic gesture. The board also approved a succession clause naming Rebecca Neumann, Adam's spouse, as the person with first rights to choose his replacement as chief executive officer. With these provisions, effective control of WeWork was locked inside the Neumann family. The same meeting included a waiver for a glaring conflict of interest: the company's purchase of the We trademark from Neumann himself for $5.9 million proceeded without an independent valuation. Board minutes referenced in later litigation show that 2 independent directors objected to the concentration of power and the lack of meaningful review. Their dissent was recorded, but the final vote was 7-2 in favor, enough to override any opposition. Legal counsel from Skadden Arps issued a memo warning that the charter amendments could expose the board to shareholder lawsuits under Delaware law. The warning was noted, then ignored. With these approvals, Neumann gained unilateral authority over financial metrics, lease expansion, and personal transactions. The board had the evidence of risk in front of them: a founder cashing out, selling company assets to himself, and entrenching his own control. Yet the structure was approved and the valuation narrative was allowed to run unchecked. Any external warning could be muted internally with a single vote. On October 11, 2018, a single meeting set the floor for WeWork's valuation. Masayoshi Son, head of SoftBank and architect of the $100 billion Vision Fund, spent 12 minutes with Adam Neumann and his executive team. The result was a promise of billions in new capital and an implicit demand: the company's next round would not be priced below $40 billion. Internal SoftBank memos later cited in court filings reveal the logic behind this number. For the Vision Fund to hit its target internal rate of return, 30% across the portfolio, mega deals like WeWork had to be valued high enough to justify the billions already deployed. Anything less would drag down the fund's performance, erode Son's reputation, and risk future fundraising. The pitch was built on numbers that had already been engineered for this moment. Son's team projected $1 billion in adjusted EBITDA by 2022, relying on the community-adjusted metric that excluded the very costs driving WeWork's cash losses. Lease obligations, occupancy risk, and negative operating cash flow were glossed over in favor of a global expansion narrative. The Vision Fund's committee, according to internal correspondence, required a $40 billion plus headline to greenlight another $5 billion in follow-on funding and to justify the $10 billion already invested. This was not a negotiation over fair value. It was a negotiation over optics, portfolio math, and the need to defend prior decisions. The 12-minute meeting did not just set a number. It locked the company, its board, and its largest investor into a valuation that no longer reflected operational reality. The institutional incentives were clear: endorse the metric, back the founder, and keep the story alive, at least until the public markets demanded proof. On August 14, 2019, S1 hit the SEC's public database. The document spelled out $47 billion in lease obligations, a revenue model built on month-to-month memberships, and a headline metric, community-adjusted EBITDA, that erased the company's core costs. Within hours, the financial press dissected the filing. Bloomberg and the Wall Street Journal zeroed in on the accounting sleight of hand and the mismatch between long-term liabilities and short-term revenue. Behind closed doors, bankers at Goldman Sachs and Morgan Stanley circulated risk memos flagging material misstatements and warning of a cash burn projected to top $2 billion in the coming year. By the third day, the initial public offering was withdrawn. In less than 72 hours, WeWork's implied valuation collapsed from $47 billion to under $4 billion in the secondary market. The public narrative flipped overnight. What had been sold as a generational growth story was now exposed as a house of cards, with every major underwriter and investor scrambling to limit their exposure. Adam Neumann walked away with $1.7 billion in an exit package, including SoftBank stock, consulting fees, and personal loan forgiveness. Nearly 12,000 WeWork employees lost their jobs in the aftermath. The average severance payout was less than 1% of the founder's haul. By November 2023, the company's Chapter 11 filing listed an enterprise value of just $44 million, erasing nearly all of the $47 billion once claimed. Yet in 2022, Andreessen Horowitz wired $350 million to Neumann's next venture, Flow, before it had signed a single tenant. The pattern repeats. Capital follows narrative, not results. $47 billion was not a market verdict. It was a boardroom decision, engineered by insiders, ratified by institutions, and insulated by invented metrics. Today, private valuations still outpace fundamentals by orders of magnitude. The next collapse is not a question of if, but when.